What if I told you that the biggest threat to Bitcoin, stocks, and the global economy isn't America? It's Japan? For decades, Japan has been lending cheap money to the entire world. But now, that system is breaking. Rising bond yields, a collapsing yen, and a financial crisis. Nobody is talking about could trigger the next global liquidity crunch. Here's why every crypto investor should be paying attention. Welcome back to Lost Coin Explained. Today we're breaking down why Japan's financial system matters more than most people realize, and how it could affect Bitcoin, crypto, stocks, and even your investments.
Thursday, July 2nd, 2026. Today we're going to look at how Japan is breaking. Yes, the world's biggest carry trade is starting to crack. And for years, I've told you to keep an eye on Japan, not because Japan has the biggest economy in the world, but because it's been one of the biggest providers of liquidity to the entire global financial system. And I even have a playlist, the Japanese yen carry trade, and I'm going to put it up here in the cards. And I've been warning about this eventual denouement, if you want to call it, for quite a few years. Well, since I started this channel really back in late 2015. And today, unfortunately, the warning signs are flashing brighter than ever. For example, as I speak this morning, JGB yields have resumed their rise. We've had a bit of a reprieve in the bond markets in the last few weeks, but the 30-year JGB yield is back above 4%. And that's quite a big move, because up until 3 years ago, JGB yields were near zero. The 10-year was negative, and the 10-year today is almost, back above 2.7%. It doesn't sound that bad, but considering it used to be at minus yields, and considering that the Bank of Japan kept rates below 1%, near zero and negative for like 30 years. It's a big deal. But despite that, the yen is falling, and so the dollar is rising. It's going above 162. That's a 40-year low or 40-year high for the dollar as well. And it equates with the weakness in the government bond market. So what I want to do today is explain to you why this is happening. First, why it's happening. Well, as I've said many times before in other videos about Japan, they've had decades of zero interest rates. And did you know that recently the BOJ raised the base rate to 1%? And that was the first time, I think, since 1995 or 96, that rates went back to 1. So it's crazy. They've had negative interest rates, as I said. They've been doing yield curve control. And there's been a lot of borrowing in yen, not just in Japan, but by financial institutions, by funds, by investors all around the world, because the yen has always been very cheap. But now the yen is getting expensive, of course. But the important thing that you need to understand is that all this liquidity that Japan provided, that would be taken and put into U.S. treasuries, U.S. equities, hedge funds, real estate or property, private equity, and commodities. So Japan became the world's banker because money there was essentially free. But all that is ending now because Japan is in the throes of a currency and bond crisis, pretty much like a third world country. Not as bad yet, but it's the kind of stuff that happens in Turkey, Lebanon, and other places like that. So the BOJ has been raising rates, as I've said, but that isn't stopping the lack of faith and confidence in the longer end of the bond market. As I've said, longer dated bonds have experienced a historic sell-off, and I think it's going to spill over into our markets. Investors are demanding a much higher compensation for lending to Japan. And this isn't just because of inflation. It's becoming a confidence issue. And why is that? Well, because Japan has enormous government debt to GDP. I think it's around 230%, maybe even a little more. Has an aging population. It has huge refinancing needs. And the BOJ has reduced the buying, even though the BOJ owns almost half of the Japanese bond market. So why is the yen still falling? There's usually the argument that higher interest rates are good for a currency, but in this case, it's leading to higher yields on the longer end of the curve. Yes, the BOJ has raised the base rate to 1%, but we're seeing that the 30-year, the 10-year are way above that 1% level. What that is saying is that the BOJ is behind the curve, but it can't afford to raise the short-term rate that much more and that quickly. So that leads to a flow out of the long-term bonds. And it makes the yen still weaker because the price of those bonds is going down very quickly. So why is the yen weakening so much then? Why is there not much confidence in what the BOJ is doing? Well, mainly because of Japan's fiscal position. The higher bond yields go, the more it costs to refinance. Japan is heavily dependent on energy imports, and we know what's been happening in the energy markets. And there's also a widening interest rate gap with the US, and there's continued capital outflows. Japan has spent tens of billions of dollars trying to defend the currency, yet the yen has continued to weaken, and officials are again warning they could intervene. So why does this matter globally? Well, if Japanese yields continue rising, Japanese investors may eventually prefer to own Japanese bonds. And what does that mean? Well, that means selling US treasuries, selling UK gilts, selling European bonds and foreign stocks. And that withdraws liquidity from the world. So for decades, Japan has exported capital. What happens if Japan starts importing capital? It's a big question, and I think we're going to find out very soon how that's going to play out. And I don't think it's a good thing. So where does gold come into this? Where does gold come in versus, let's say, government bonds? Well, as I've said many times, for 40 years, there was a government bond bull market from like 1981 to 2021. And government bonds were considered risk-free. But today, as we're seeing in Japan and in the US and in the UK, they're becoming one of the riskiest assets in real terms. While gold has no counterparty risk, no default risk, and no central bank liability. So what a lot of people don't realize is that the biggest bull market of the last 40 years wasn't really stocks. It was government bonds from 1981 to 2021. And that era appears to be ending. And I think investors and the financial markets still don't realize that there's still a lot of people out there who think we're in a bond bull market, that yields will go back down. And it's probably one of the reasons why the stock market's still quite elevated. So whether you're watching the markets on Wall Street, in London or Frankfurt, keep one eye firmly on Tokyo. I'm going to put a link below in the description to where you can follow the JGB yields. And as I've said, Japan has been the cheapest source of money on earth for decades. And if that changes permanently, it changes everything. The world's financial system has been built on cheap debt. The question now is, what happens when the price of that debt finally starts to matter? So, yeah, interesting times. And with that, I'm going to wish you all a very good day. Take care. Bye.